just here. Good morning, grade 11s. Mrs. Boyens here. We're going to look a little bit today just at the notes. If you've got it here with you, page 15 and 16, we're just going to stand a little bit still at the benefits of establishing a company versus other forms of ownership. If we're done with that and you have perhaps any other specific question, then I'll be happy to go through that. Here and there, I've also picked up some errors in the notes that we can just make sure that you have fixed it. We'll look at that together. I'm going to put on the screen share, then maybe those of you who perhaps don't have the notes in front of you, let me just go to this one. See if it works. Okay, there we go. Okay, no, wait, that's the partnership one. I will get to that one as well. It's this one. Let me just quickly check. First of all, grade 11s, if you've got your notes with you, an error that I've picked up here on page 13 at the top where they say differences between the private and a personal liability company. Can you see that over here they said state owned? So just change it for yourself to a personal liability company. I'm sort of typing it in here now as well. Liability company. So that's an error that I've picked up. Okay, then let's go down to page 15 and 16. I'm going to work through that and then just discuss it slightly. And if you've got a question or you want to add something, please do so. We said, or if you look at the exam guidelines and the curriculum, if I can put it that way, they say that in grade 11 we are focusing on this specific section of what are the benefits and challenges or disadvantages of starting a company versus other forms of ownership. Now remember in class, I hope you can still remember, feels like a year ago, I stressed that you must carefully look at the question. So what are we comparing a company to? Is it a sole trader? Is it a partnership? Are we comparing it to a closed corporation? Because that will change your answer. And also, are they talking about a public company versus another form of ownership, or a private company versus another form of ownership? I don't think they will compare a personal liability company, because we learn very little facts about it, and I think they are focusing on a public company and a private company. So let's just go through what they've given us, and I just want to sort of expand or reiterate a little bit here and there, just so that we can put in context with regards to the other forms of ownership. Okay, so if we look at, if you take a company, a company's legal status and liability, both a public company and a private company obviously are legal entities. They have their own legal status, trading name, and owns their own assets. Now remember, oh, okay, now I hear a little bit of a, okay, no, it's gone. Remember that that's basically the basis of comparing forms of ownership, or looking at a specific form of ownership, is whether the business itself has legal entity or not, because that determines a lot of other things. So shareholder, as a result of that, because the company has got a legal entity, or is a legal entity, the shareholders or the owners' private assets are therefore protected. So the owners, the shareholders of a company, private or public company, have limited liability. So if I bought shares in a private company for 50,000 rand, that's what I've invested. I'm now an owner, part owner of that company. If the company goes bankrupt, I will only lose that 50,000 rand. The creditors can't come and take my car or my house. So that's a nice benefit of any business that you invest in that's got its own legal entity. So if you compare it to sole trader partnership, those two forms of ownership do not have legal entity, and therefore it's a benefit of starting a company versus those other two forms of ownership. And as a result, bullet number 3, the shareholders therefore have no direct responsibility for the debts of the business. Maybe you could just add that on there. right? And then linking in with bullet number 1, companies have their own names and these are protected. But once again, if you register a trading name, well, for a partnership as well, those names are also protected. But anyway, with regards to companies, those names are protected. All right, the next one that you can then compare your companies versus your other forms of ownership as a benefit. Remember, we're now first just looking at benefits, is that shareholders share in the profits of the company through dividends. So please make sure that you specify dividends, because a sole trader and a partnership, partners in a partnership, and even a closed corporation, which also does have legal entities, they also share in the profits of the business. So I think the emphasis should be that it's through dividends that the shareholders are receiving profit or share in the profit. Okay. Then ownership and management, the next one, that should actually be number 3, 4, and so on. So let's maybe just see if I can change that from the now. Right. Ownership and management, shareholders are able to buy and sell shares freely in a public company. Please somehow highlight public company for us, because if they ask you to compare, for example, a private company to other forms of ownership, this line would not be true, because a private company, you have to get most of the permission from the other shareholders before you can sell your shares. You can't just sell it to anybody. So this first line only applies to a public company. Okay, let me try and shall we do this? Okay, no, yeah, those two. Good. Right. The company is managed and by qualified and competent board of directors. So that would then obviously apply to a public and a private company. So that is a nice advantage if you have qualified and competent directors. Then remember, we spoke about this, I can still remember in class, we said a company is less likely to use consultants as it has a larger pool of skills and expertise. This should be linked to the directors. If they have a good skills and they are competent, then usually the companies do not have to outsource certain functions. If you now think of perhaps a sole trader where it's only the one owner in the business, maybe he doesn't even have a manager or anybody, usually his skills should be much less or fewer than a board of directors of a company. Okay, good. The next one, who's drawing dots? Thank you. The next one, directors are more likely to take risks and allow for growth in the business. Because we say these people are competent, they have a lot of skills, and they are experts in their field, they are more likely to take some risks, and that could be to the benefit of the business. You know, if you're on your own, or maybe you have a small partnership, you might be scared to take risks, but because the directors also have the backing of the shareholders and usually funds available to take risks and to grab some business opportunities, that can be good. Let's move on to capital and cash flow. A company have, let me just go to that. A company may have more investors, not the apostrophe S, to fund the setting up of the business. Once again, this applies to a private and a public company, obviously depending on how many shares the business will issue or the company will issue, that will be converted into cash or capital that's available. Then they say companies have a better cash flow than sole traders. Once again, grade 11, that's a little bit subjective, because we honestly don't know. That's one of the ones where I would say, okay, the department said so. It's not always necessary, the case necessarily. I think they mean it's because the company might have. Who's talking there at the back? Companies may have more cash flow available because of the selling of shares. Okay. Then a company is not limited to the individual contribution of the members' capital. Yeah, maybe they can also take, a company can take out loans and apply for loans at the bank or financial institutions. Why? Because the company is a legal entity on its own. I would rather let's just change that to shareholders, because the owners shareholders. That makes a bit more sense. All right. If we take a close corporate, partnership and a sole trader, remember, in that case, the businesses do not have legal entities, so the business can't apply for a loan. The owners have to apply in their personal capacity. Where a business has got legal entity, then the business can also apply for a loan. Right. The long-term growth opportunities for companies are really good, as there are always possibilities of getting more investors. Remember, we spoke about that, where we said if a company needs to expand, maybe they want to bring in another line of products or services, or build new buildings, or need to acquire new equipment or vehicles, then they can actually issue more shares in order to get that capital, extra capital in, and it's a fairly easy way of acquiring more funds. Right. Then another advantage, directors do not have to take out personal loans to grow the business. Now, that is as opposed to with sole traders and partnerships, because the business can't take out loans. The owners for those two forms of ownership will have to do it in their personal capacity. Okay, if we look at lifespan and continuity, a company has continuity of existence. Why? Because it is a legal entity separate from the shareholders, both private and public. Okay. Company shares can be transferred, bought, or sold. So obviously there's trade. Just remember, with a private company, the person or the shareholder who wants to sell his shares must get permission from the other shareholders. With a public company, those are almost the companies that's listed on the Johannesburg Securities Exchange, there they can trade their shares freely. I mean, nobody will even know if you sell or buy. That's a nice advantage of a public company. Right, we'll just take that bullet out. Then taxation. Companies have tax benefits that other enterprises do not have. I think what they mean there is there's quite a couple of, if you go into tax law and so on, there's quite a couple of things that you might, for example, deduct if you're a company, things that if you give donations, it's tax deductible, etc. And if we compare it also with regards to the tax rates, can you still remember what the company tax rate is at the moment? Who knows? 28%. Now, if you compare that to an individual person's maximum tax bracket that individual person can fall into, that's 40, I think it's currently 45%. So 28% is quite extensively less than 45% if you had to pay tax in your personal capacity. What we must just remember is, if the company declares dividends to its shareholders, there will be a secondary tax that has to be paid on dividends, STC. But in general, companies do have tax benefits, public and private. And as we spoke, then they may obtain tax rebates. That's like deductions and things that you can play around with a little bit if you're involved with social responsibility projects, donating money, and so on. It also has caps, amounts that's capped, but you have that benefit. So those are all the benefits and advantages of starting a company, public or private, versus other forms of ownership. Let's move on to the challenges of establishing a company versus other forms of ownership. So what are the difficult things and more tricky things relating to companies as opposed to other forms of ownership? We have mentioned this in class as well. Directors may not have a personal interest in the business, and this could prevent the business from gaining maximum profits and growth. Now, remember we said the directors, they might have shares in the business, but it's not in the company, but it's not a prerequisite. So sometimes these people, they get paid salaries, and usually, especially with your public companies, the directors get nice big salaries. So I'm getting a nice salary. I can take the risks. I'm using other people's money for the benefit or for the growth of the business. But if something goes wrong, I'm still getting my salary. I'm not losing anything. So that can sometimes be a big disadvantage for a company with regard to the fact that the director might not have personal interest in the business. So yes, they will go for it and take risks, but sometimes that can be negative as well for the company. The directors who do not have personal interest in the business, in the company, might not attract investors. If investors perhaps, especially with your public companies, do some research and they find out that the directors of this company do not have shares in that specific company, it might ring a little bit of a alarm for investors to say, but listen, this person is a director of this company, but he doesn't even own any shares. So what is the connection there? And then it might not attract potential investors. There might be a conflict, or maybe a conflict between the owners of the company, the shareholders, and the management in control. Now, usually with your companies, you have shareholder meetings once a year where decisions are made, and it goes according to what you've got, one vote per share that you have. But sometimes the shareholders might not get, let's say, a majority vote, or they might not be happy with the way directors are doing something, and then it's sometimes difficult to get something voted in or voted out. So that might be a challenge of a company versus other forms of ownership. I mean, if you think of a sole trader or partnership, the owners are, or the partners are, in most cases managing the business themselves, so they are responsible for those decisions that they take, and obviously very much personal interest in those businesses. Then obviously the more shares there are in a company, the less profit or dividends per shares will be declared. So that can be a challenge, especially for investors. So I might want to invest in this company and it seems to look fine now, but in 2 years' time they issue another 100,000 Rand shares and the profit perhaps is not growing that much. Now the profit has to be divided among all the shareholders, and then the dividends might be very small. So that could be a challenge for a company. This one, well, okay, the company is required to submit a full report to all stakeholders each financial year. Obviously, it takes a lot of time, it's expensive, so it costs a lot of money, and that could put a financial and administrative burden on the company. Then the limited, just remember with financial report that, I just want to see if I put it here. Okay, I'll come back to that one. If you want to say something else on that. Then this one, I'm not sure about this one. The owners of a company have more liability. It doesn't sound right to me, so I want you to take this one out. Obviously, we've just explained that the shareholders, the owners of a company, do not have liability for the debts of the company. They can only lose what they've invested in the company. The owners of sole traders and partnership, they've got unlimited liability. So let's take this one out. It does not make sense to me at all. All right. When directors change, there could be a lack of continuity in management. So that's now when a director decides to resign, or he gets headhunted by another company and he leaves that company. He's leaving can leave quite a gap, especially with knowledge and handing over to the new person. So that could be quite a challenge for a company. If we move on to page 16, companies have more taxation requirements and other taxes are high. So I want you to add the infamy secondary tax on dividends, or STC on dividends. So 28% is the flat rate that companies pay on profits made, but then whatever dividends or profit they're going to distribute to the shareholders, we say they declare a dividend. On those dividends, the company has to pay an additional 20%. So if you then finally add it up, 28 plus 20%, then we sit on a 48% combined tax rate. But just remember, it's only on dividends declared. So if the company, pardon, if the company keeps profit in the company and it doesn't distribute that profit, there's not tax to be paid, more tax to be paid on that. So you can maybe just add that on. They are, oh here it is, they are required to disclose all financial information which could provide their competitors with an unfair advantage. Please just add on here for me, this only applies to public companies. Remember we said, and if you did that companies, if you did that double bubble map, we spoke about that there as well. Public companies must disclose their financial information to the public because it's the public buying shares from them, but a private company doesn't have to do that. That financial information only stays with the shareholders of the private company. Public company, this is a challenge because it can this information can be used by the competitors to make strategic changes in their businesses as well. So that is a challenge. Politics can get in the way and managers are appointed for the wrong reasons. It could be a challenge, but once again, it can happen in a partnership as well. Maybe because we normally think that public companies and private companies are the bigger kind of businesses, there might be an opportunity for backstabbing and appointing my brother's cousin, nieces, that kind of thing. It can happen in other forms of ownership as well, but you can use it as a challenge. Then now they bring in state-owned companies. So once again, look at what the question is asking. State-owned companies often deliver non-profitable services. Do we need to say anything more? Just write, Mrs. Boyen said SAA. Now I'm joking, but you know how I feel about our state-owned companies at the moment. That lead to government losing money through the business. Yes, and then especially currently, our government doesn't seem to know when to stop funding bankrupt state-owned companies. But anyway, that could be a problem. Then a company can stop existing if deregistered by the registrar of companies. Not can, it will stop existing if they do not, because especially with a public company, because that company is using the man on the street, the public's money in order to run this business. There's very strict requirements that must be met, and that's set up by the registrar of companies. Currently, it all falls under the CIPC. So if those requirements aren't met, for example, public companies have to produce the financial statements within a certain period of time after the end of their financial year. If they fail to adhere to those requirements, they can be deregistered. They can be stopped from trading on the Johannesburg Securities Exchange, public companies. So not they can stop to exist, they will be stopped to exist by the Registrar of Companies or the CIPC. So that is a challenge. But once again, and if deregistered, it means their registration number gets taken away and then they are not recognized as a company anymore. But obviously, your smaller businesses will also go through that process, but maybe not as publicly as especially a public company. And then a large amount of money of the funds of the company is spent on financial audits and accounting fees due to government regulations, because, and you can write it again, especially with your public companies, the financial records, your income statement, balance sheets, and so on, need to be audited in order to make sure that this information that's presented to the public is actually a true reflection of what is happening or what has happened with the company's finances for that financial year. Okay, then. So this is the benefits and challenges in broad. With these notes, they haven't said compare it to a sole trader or compare it to a partnership. So that's why it's very important, grade 11s. Although the focus is on this part of the benefits and challenges, you have to know your characteristics of each of your forms of ownership, all of them, as well as the advantages and disadvantages. If you start with the characteristics, that normally gives you quite a good basis of being able to argue what are the advantages and disadvantages of the business. All form of ownership, always start with legal entity, because that will already tell you a lot about each of those forms of ownership. Then in last term, I also gave you this one. Just quickly check. I think we had it as a question of benefits of starting, and they are specifically indicated a public company versus a partnership. So I wanted to see if you can make that connection between those two. So see, I hope you've got it. I will also attach it again to today's class, to the notes after this class. But now go through this one as well to see if you can make that connection. Try and change it to a private company versus a sole trader and see if you can come up with those benefits, and maybe then try one with advantages as well. Okay, so this is what I was going to focus on today. Tomorrow we're going to look at the procedure and formation of companies and the legal requirements of the name of the company. I think we just perhaps touched on that last term, and then on Friday I want to start with the acquiring of businesses, the franchising. That was what we were going to do the last few days of the term when we closed down a bit earlier. Do you have any questions? Anybody who's perhaps got a question, even on the previous part of the work as well, of forms of ownership that you perhaps want to clarify, or perhaps have a question on? Jacqueline, Lindiwe, Bokang?
No, ma'am, I don't have a question.
Okay, Bokang says he's fine. Lindiwe says she's fine. Jacqueline, are you fine?
Yes, ma'am.
Okay, wonderful. Listen, and please, if there's any questions, you can also pop it on onto Google Classroom, and I'll try to answer as quickly as possible. And yes, it was nice to hear a few girls' voices. I haven't heard Bokang's voice there, but it was nice to see you. And yeah, please stay safe and stay well. And I really miss you guys. Then we'll have another session tomorrow. I think I will probably schedule it for the same time. I think 12 o'clock is perhaps a good time. All right. Okay. Have a wonderful day. We'll speak again.
Thank you, ma'am. Bye.
Bye.
Bye.